Welcome to Accounting for Senior Cycle, Chapter 3, Bank Reconciliation Statements. For bank reconciliation statement, we will never talk about bank reconciliation statement without having a bank account. So that means we're talking about individual bank accounts or businesses' bank accounts. So as soon as a business has its own bank account, or as soon as an individual has its bank account, it starts transactions with it, with the rest of the world, or with the third parties. So a bank statement will allow a business or an individual or business to keep track of its transactions. So let's go further down. Bank statements. A bank regularly sends its customers, that's businesses and individuals, a bank statement. Example given at the end of each month. This document is a record of all transactions that took place in their current account since the previous statement. It shows the balance on the account at the beginning and at the end of the period. We have a bank reconciliation statement. We have a bank statement because we have opened a current account or a savings account in the bank. As soon as we open this account, it is important that we transact in this account. So the details of our transaction with third parties will be recorded through the bank statement. And at the end of the month, the bank will either give us a paper or a digital one online for reconciliation to check what our transactions are in day-to-day activity. So when the bank statement is received, it should be compared with the organization's own bank account in its own record. The balances should agree, but this is often not the case. Hence, the need for a bank reconciliation statement. As soon as a bank statement is received by the business, the next thing is to check, to compare and contrast the bank balance with the office own account balance to see if they tally. But most of the time, that is not the case because there are some hidden transactions. There are some transactions that would have been done, maybe interest received, maybe bank charges or the rest, or some accounts, some checks have not been credited as at when the bank statement has been, as at when the bank statement was issued, or probably there is a dishonored check. So there are different reasons why the bank might not, the bank statement might not tally with the office account, own account. But as soon as we go further, we'll talk about the causes of differences between the office own account and the bank account. But before then, we have to go into or look into the purpose of the bank reconciliation statement. A bank reconciliation statement has several purposes. One, to reconcile the balance of the bank statement with the balance of the business's own bank record. So the first reason why we need a bank reconciliation, or why we carry out a bank reconciliation statement, is to compare and contrast the figures we have, the balance we have in the office account with the bank balance, either the credit balance or the credit balance. So we want to know the figures. We want to check if the balance in our office own account is the same as the balance in the bank account. That's the first purpose. The second purpose, to calculate the bank figure for the purpose of preparing the balance sheet. There's a balance sheet, which is a record of the business assets, liabilities, and equity. So we need figures from the bank statements to be able to prepare our balance sheet. And the third purpose, to ascertain the amount of money the business has in its bank account, which is the debit balance, or owes to the bank, which is the credit balance, at the end of the month. So a bank credit balance is known as a bank overdraft. Another purpose why we need to have a bank reconciliation statement is to know our debit balance, which is the bank account, which is what we have as a business or as an individual, and our credit balance, which represents what we owe to the bank. So if our account is reading a credit balance, it simply means we are owing the bank, and it will be called a bank overdraft. So what is a bank overdraft? A bank overdraft is a credit facility which allows a bank holder to withdraw more than its credit available balance in the bank account. That's an overdraft. So as soon as your bank statement is reading a credit, it simply means you are owing the bank. So these are the purpose of a bank reconciliation statement. So we go to the reasons for differences between the bank balance and the business's own calculation. What are the reasons why we could have differences in the bank balance and the business owns calculation? I'll be right back, please. So what are the reasons why we could have differences between the bank balance and the business's own calculation? The first reason why we could have differences in the bank balance, that's our bank statement, and the business owns calculation is that there may be time lag. And when we talk about time lags, we're simply talking about time delays. And what are the reasons why we could have a time delay? A delay between the time of recording the transaction in an organization's bank record and it appearing on the statement. There might be time lag between, as soon as there's a transaction that is done, the business might have recorded it immediately on its bank account, but it might take time for the bank to record it in its own account. And as a result of that, it might bring about delay and differences between the bank statement and the business's own account. For example, lodgement rate not yet credited by the bank. An individual or a third party might have lodged a check or cash into the bank account, which the business has been notified. And as a result of that, the business has it in its own account. But the bank might have not recorded it in its own account. As a result of that, it will be missing when the bank statement is being dispatched to the account holder. Another example is checks not presented for payments to the bank. Unpresented check. So if there's an unpresented check, it simply means the bank balance will be more than the business owns balance, because the business would have deducted that amount from his own account as a credit. But on the other hand, the bank has not debited or credited the business on its own. So what I'm simply saying is that if there is unpresented check to the bank, so an individual might have issued a check to its supplier, which simply means the bank should debit the individual business in its bank account, but the bank has not debited the individual. But on the other side, the individual or the business has taken that amount of money from its own account. So when the bank statement comes out or it's been dispatched, the bank balance will be more than the credit or the business owns balance. Another reason is that payments made directly to the bank, example, credit transfer. If there's a credit transfer, that's an online transfer, the individual business might not be aware of that transaction, but it will appear in the credits, it will appear in the bank statement of the business. So a direct transfer might not reflect in the business owns account, but it will reflect in the bank statement. So these are time lags in between. Another reason is unknown entries. I want to talk about unknown entries. Either the bank or the organization is unaware that a transaction has taken place. So we are simply talking about probably a dishonored check, bank charges, standing orders, or direct debits. So either the bank or the individual holder, the account holder, does not know that certain account or certain transaction has been done. Yeah, a standing order might be given, probably like a standing order to debit you probably for your Netflix account, for your Dazzling account, for different transactions that you do at the end of each month. But the account holder might have forgotten about it. As a result of that, do not record it, and the account has been debited for such transaction. So this might also bring about differences in the bank statement and the business owns account. Then the bank charges, commission charged, dishonored check. The bank would have, for a dishonored check, the account holder would have credit its account for this account, but the bank might have not debited the amount in question because the check has been dishonored, the check has been returned to the account holder. So this would also bring about differences in the bank statement and the business own calculation. And the third reason why we could have differences in the bank statement and the bank calculation and the business own calculation is that there could be errors. And when we talk about errors, either the bank or the organization has made an error in recording a transaction. It could be calculation error. It could be incorrect amount recorded. Maybe 459 should be recorded instead of 945. Errors of omission or errors of commission. This might also bring about differences in the bank statement and the business owns account. So we continue. So the effect of bookkeeping entries on the bank balance. The effect of bookkeeping entries on the bank balance. We're talking about what makes the bank balance to increase and what decreases the bank balance. So we're going to start. The bank balance increases when one, any lodgement are made to the bank. As soon as any lodgement is made probably through sales, that's cash or check, has been lodged to the account or to the bank, it increases the bank balance. Two, any lodgement are made to the organization's bank account by others, that's probably interest received. So whatever lodgement that has been made to the bank, to the account holder's account in the bank, it will always increase the bank balance. Then, what are the situations that bring about a decrease in the bank balance? Number one, any payments are made by the organization, example, check, direct debit, or standing order. Whatever transaction that has been done that involves the account holder to make payment, it will decrease the bank balance. Any cash withdrawal made by the organization, any cash that has been withdrawn by the bank, by the account holder, will bring about a decrease in the bank balance. Any financial charges made by the bank, whatever charges that the bank has made, probably interest on bank overdraft or commission, to also reduce the bank balance. And lastly, for today, so the bank account debits and credits. For items that increase the bank balance, the organization will debit bank account, the bank will credit the organizational bank account. So to increase the bank balance, the organization will debit the bank account. Then the bank will credit the organizational bank account. So what I'm saying is simply this: for the bank balance to increase, the organization will debit its own accounts, and at the same time, the bank will credit the organization's account. For a decrease in the bank account, the organization will credit its own bank account, and the bank will debit the organization's bank account. So in the next class, we're going to talk about the preparation of bank reconciliation statement. Until then, take care.